Ever wondered what an index fund is and why so many financial enthusiasts rave about it? Well, allow me to demystify this for you. An index fund is a type of mutual fund or exchange-traded fund with a portfolio constructed to match or track the components of a financial market index, such as the Standard & Poor's 500 index. It's like getting a little slice of the entire market in one neat package. One of the reasons they are so popular among investors is their simplicity. With index funds, you don't need to be a Wall Street whiz to make a smart investment. It's a hands-off approach to investing that doesn't require you to constantly monitor your portfolio or make frequent trades. And that's just the tip of the iceberg. Now that you have a basic understanding of index funds, let's delve deeper into why they're beneficial. Join me as we explore the core benefits of index funds, getting started, key strategies for success, and more. Why are index funds a darling for many investors? A simple question with a compelling answer: cost effectiveness and diversification. Let's dive deeper into these core benefits that make index funds so attractive. Firstly, index funds are cost effective. In the world of investing, every penny counts. High fees can erode your profits, making it harder to achieve your financial goals. With index funds, you're bypassing the need for a fund manager who actively picks and chooses stocks. Instead, index funds simply mirror the composition of a specific index, like the S&P 500. This automated approach keeps operating costs low, and those savings are passed on to you, the investor, in the form of lower fees. Now, on to diversification. When you buy an index fund, you're not just buying a single stock, you're buying a small piece of every company that's part of the index your fund tracks. This means you're spreading your risk across many different companies and sectors. If one stock performs poorly, it's offset by the performance of others. Diversification can smooth out the bumps in the road, providing a more stable journey towards your financial goals. Lastly, let's touch on long-term performance. It may come as a surprise, but over the long haul, index funds have often outperformed their actively managed counterparts. While it's true that some active funds can beat the market in the short term, consistently doing so over many years is a difficult feat. Many studies have shown that, over time, the average investor can often achieve better returns by simply investing in a low-cost, diversified index fund. So, to wrap it all up, index funds offer cost-effectiveness due to low fees, broad diversification, and potentially better long-term performance. With these advantages, it's easy to see why index funds could be a smart addition to your investment portfolio. Interested in index funds? Here's how to get started. First, let's talk about picking the right index fund. You'll want to consider 3 key factors: the expense ratio, the index being tracked, and the fund's performance history. The expense ratio is essentially the cost of owning the fund. It's expressed as a percentage of your investment. Lower is generally better because high fees can eat into your returns over time. Next, consider the index that the fund tracks. An index is a group of stocks or bonds that represents a specific segment of the market. For example, the S&P 500 is an index of the 500 largest publicly traded companies in the United States. You'll want to choose an index fund that tracks an index aligned with your investment goals. Lastly, take a look at the fund's performance history. While past performance isn't a guarantee of future results, it can give you an idea of how the fund has done in different market conditions. Once you've chosen an index fund, the next step is to open an investment account. There are several types of accounts to consider, including individual retirement accounts or IRAs and taxable brokerage accounts. Each has its own tax implications and rules about withdrawals, so you'll want to choose the one that best fits your financial situation and goals. Now let's talk about choosing an investment platform. There are many out there, from full-service brokerages to robo-advisors. When deciding, consider factors like fees, customer service, and the range of investment options available. With your account open and your index fund chosen, it's time to invest. This is where your basic investment strategy comes into play. It's important to focus on long-term investing and regular contributions, a tactic known as dollar-cost averaging. This means investing a set amount at regular intervals, regardless of the fund's price. Over time, this strategy can help smooth out the highs and lows of the market, potentially leading to more consistent returns. Remember, investing in index funds is not about trying to time the market or pick the next hot stock. It's about building a diversified portfolio that grows steadily over time. And one last thing before we wrap up, don't forget to rebalance your portfolio periodically. This means adjusting your investments to maintain your desired level of risk as market conditions change. Getting started with index funds is straightforward, but to succeed, you'll need a solid strategy. Ready to maximize your index fund returns? Here are some key strategies. Firstly, let's talk about asset allocation. This is the process of spreading your investments between different types of assets, like stocks and bonds, to balance risk and reward. When it comes to index funds, you'll want to allocate between stock and bond index funds. The ratio will depend on your risk tolerance. If you're younger and have a higher risk tolerance, you might lean more towards stock index funds. But if you're closer to retirement or prefer less risk, you may want a higher proportion of bond index funds. Remember, the goal is not to eliminate risk, but to manage it in a way that aligns with your investment goals and comfort level. Now let's move on to avoiding common pitfalls. One common mistake is trying to time the market, that is, attempting to buy low and sell high. While this might sound good in theory, it's nearly impossible to do consistently. Instead, it's wiser to stick with your investment plan regardless of market conditions. This brings us to another pitfall: neglecting portfolio rebalancing. Over time, your original asset allocation might shift due to changes in market conditions. Regularly rebalancing your portfolio helps maintain your desired level of risk and return. Lastly, let's discuss the power of compounding and the importance of maintaining discipline in investing. Compounding is when your earnings generate even more earnings. You receive interest not just on your original investments, but also on any interest, dividends, and capital gains that accumulate. This snowball effect can result in exponential growth over the long term, especially in index funds, which are known for their steady, long-term growth. However, compounding only works if you give your investments enough time to grow. This is where discipline comes into play. It might be tempting to pull your money out of the market during a downturn, but remember, investing in index funds is a long-term strategy. Stick to your plan, keep making regular contributions, and let compounding do its magic. In conclusion, successful index fund investing involves a balanced asset allocation, avoiding common pitfalls like market timing and neglecting portfolio rebalancing, and maintaining discipline to allow for compounding. It's not about making quick gains, but about building wealth over the long term. With these strategies, you're well equipped to navigate the world of index fund investing. That's a wrap on our introduction to index funds. We've covered some ground today, haven't we? From understanding the allure of index fund investing, its cost effectiveness and diversification, to its impressive long-term performance. We've also dived into how to choose the right index fund, open an investment account, and employ a basic yet effective investment strategy. Just as importantly, we've touched on key strategies for success, including proper asset allocation, avoiding common pitfalls, and the significance of consistent investing. It's crucial to remember that consistency is the key to unlocking the power of compounding and maintaining discipline. If you found this content enriching, please do us a favor and hit that subscribe button. Leave your comments below with any questions or topics you'd like us to cover. And don't forget to share this video with anyone who might find it helpful. Remember, investing is a journey. Stay curious, keep learning, and you'll go far. Until next time.